The Federal Reserve, usually called the Fed, is the central bank of the United States. Created in 1913, it currently sits at the center of the American financial system. Whether it is huge banks like J.P. Morgan Chase, Bank of America, or Wells Fargo, or even smaller regional banks, they all operate inside a system that is heavily influenced by the Fed. The Fed not only helps shape interest rates, but also the money supply, the banking rules, and even how the economy responds during a crisis. In other words, this is an institution affecting everyone's life in the nation. And so, in this video, we are going to look at 5 major reasons why the United States has a Federal Reserve. It will answer why it was created, what problems it was designed to solve, and why, more than 100 years later, it still plays such a huge role in the economy. Let's get into it. The first reason the US has a Federal Reserve is to stop financial panics. Before the Fed existed, banking in America was quite rough. Between roughly 1800 and 1913, the United States experienced more than 10 major banking and financial panics, with several of them being quite destructive. Back in the days, if enough people got nervous and rushed to pull their money out of banks at the same time, banks could suddenly collapse because they simply did not keep all customer deposits sitting in a vault waiting to be withdrawn. So imagine that unlike today where you can also use credit if you have no cash in the bank. Back then, if you had zero, you had zero. That's $0 to buy food and stuff. That's zero revenue for businesses. And that's zero revenue to pay workers. Like I like to say, it is a total mess. And so that fear helped lead to the creation of the Federal Reserve in 1913. One of the Fed's biggest jobs became acting as what economists call a lender of last resort. Basically, when panic spreads and banks suddenly need cash to survive, the Fed can step in and provide emergency support to stop the financial system from collapsing completely. And while financial crises still happened afterward, like in 2008 or 2020, the United States has generally seen fewer full-scale banking panics than in the century before the Fed existed, and most have been far less devastating than the repeated collapses of the 1800s. And that leads us to the second reason the US has a Fed, and it is to make the US dollar more elastic. So you see, before the Fed, the American money supply was much more limited because the country operated under versions of the gold standard, meaning the amount of money in circulation was tied closely to gold reserves. On paper, that sounds great and stable, since it makes it impossible for governments to create endless money, right? But in practice, that's mainly why the total collapses used to occur in the first place. Imagine a random farmer in the late 1800s during the off-season. He still needed to pay his workers, to buy his supplies, and to keep his business running. But cash was harder to find because money itself was limited. Banks would not necessarily have enough currency available to lend, businesses would cut spending, workers would suddenly have less money to buy things, stores would make less money, and before long enough, the slowdown would spread everywhere. So one of the Federal Reserve's jobs became making the money supply more flexible and elastic. In other words, to make it easier to create money. At least that's how I like to say it. Today, the Fed can inject money into the economy during crises to help prevent complete collapses in spending and lending. You saw this during the 2008 and 2020 financial crises when the Fed stepped in aggressively to keep credit flowing and stop the economy from freezing entirely. Of course, creating too much money can create new problems, which brings us to the Fed's next major responsibility: controlling inflation while protecting the job market. Some people call this the dual mandate, and this is probably the part of the Fed most people hear about in the news. When inflation rises, reporters suddenly start talking about interest rates. When unemployment jumps, people start asking what the Fed is going to do. That is because one of the Federal Reserve's biggest responsibilities is trying to balance two things at the same time: stable prices and strong employment. In simpler terms, the Fed wants inflation low enough that money keeps some of its value, while also trying to keep the economy healthy enough that people can still find jobs. Now, you might be wondering something. If inflation makes things more expensive, why does the Fed not just aim for zero inflation? Well, surprisingly for many people, economists generally think that a little inflation is actually healthier than none at all. At the time of this video, the Fed aims for roughly 2% inflation over time. The logic is that inflation should stay low enough that prices do not spiral out of control, but high enough to avoid something called deflation, which is when prices consistently fall. That might sound good at first because buying cheaper stuff always sounds great, but deflation can actually freeze an economy because people stop spending because they wait for prices to drop. That leads to businesses making less money and companies starting to lay off people, and then everything slows down economically. So how does the Fed actually influence inflation and employment? Mostly through interest rates. When inflation is too high, the Fed often raises interest rates to make borrowing more expensive. That means fewer people take loans, businesses slow expansion, spending cools down, and inflation can start easing. But when the economy weakens and unemployment rises, the Fed can lower interest rates to encourage borrowing and spending again. Cheaper loans can help businesses invest, consumers spend more money, and jobs become easier to create. It is not perfect, and the Fed definitely does not always get it right, but that balancing act is one of the biggest reasons it exists. Now, the fourth reason America has a Federal Reserve is to watch over banks and try to stop them from becoming dangerously reckless. Banks make money not only by lending money, but also by investing and trying to earn returns. And sometimes, banks can become overly aggressive. They can start chasing profits while ignoring what might happen if things suddenly go bad. That becomes a huge problem, because if a major bank collapses, the damage can spread far beyond just one company. Suddenly, businesses lose access to loans, people panic, markets crash, and confidence disappears. So no, you don't want banks going bust. And so to supervise all this, regulators care about whether banks could survive if disaster hit tomorrow. Meaning, could they handle a recession? Could they survive rising unemployment? What happens if markets suddenly crash or borrowers stop repaying loans? To figure this out, the Fed runs what are often called stress tests. These are basically boring financial survival exams where major banks are tested against hypothetical crisis scenarios to see if they have enough capital to survive hard times. And contrary to popular beliefs, the 10% cash reserve requirement is not necessary anymore since 2020. So basically, the fourth reason the US has a Fed is partly to stop banks from becoming ticking time bombs. It can't stop them all, but it can manage them. The fifth major reason the United States has a Federal Reserve is basically to act as the bank for the US government. And honestly, one of the easiest ways to think about this, in my opinion of course, is that the Fed acts as a giant national checking account manager, though it is not literally a checking account. The US government collects huge amounts of money through taxes, spends enormous amounts on programs and services, and constantly moves money around the economy. Somebody has to process all of that, as well as tracking everything and making sure the system works efficiently. And that's basically what the Fed does. When tax refunds are sent out, when Social Security payments go out, or when the government spends money on programs, the Federal Reserve helps process and move those payments throughout the banking system. And during economic emergencies, this role becomes even more important. Think back to the stimulus checks during 2020 and 2021. Back then, the government approved massive payments to millions of Americans, and the financial system needed infrastructure capable of actually moving all that money quickly and securely. That is part of what the Federal Reserve helps coordinate. The 5 reasons mentioned in this video are not the only functions it has, but there are pretty much some of the most important ones to know to understand the usefulness of the US central bank on the economy. And speaking of the economy, if you're serious about your finances and want to have a nice budget planner book to help you track your finances, in the video description, you'll see 3 different Amazon links to order one for yourself. If you pick one of them, it would also directly support the channel. So anyways, if you enjoyed this video and want to see similar content, make sure to give it a like and click on one of the videos showing on your screen right now. I'll see you there.